right, welcome back to the Real Estate Huddle. We're excited to be here today for episode 92, and today we are going to talk about probably the fastest way potentially to pay off your mortgage. And it's also probably the most underutilized good product out there. And we've got James Stanke from CMG Home Loans here with us as a special guest. So welcome, James.
Thank you for having me. Happy to be here.
Absolutely. Yeah, we're excited to be here with you. So I think people need a lot of education on this product because I'll be honest, like I have like heard very little of it. I watched a YouTube video on it like 10 years ago from this guy with like an Australian accent, and it seemed kind of fishy. I was like, I don't know if I trust this guy because he's like, you could pay off your mortgage in 7 years and this and that. And then I was like, no way. Like, it seems like too good to be true, right? So now I understand it better because you've helped me, get educated on it and stuff. But this is the all-in-one loan, right, that you guys offer.
Yep.
And tell us a little bit about like how this is different than your normal like 30-year fixed mortgage that we're so used to.
Yes. So really, the all-in-one loan is basically just a loan that's connected to your checking account. Let's say you have a balance of $400,000 loan. You buy a house for $500,000. You put 20% down. Your loan amount's $400,000. This account it's through a bank. It's called North Point Bank, and this is kind of a fun fact. But CMG were the only one who does it, and we actually took this loan to like Bank of America, U.S. Bank, bigger banks, and we're like, hey, we want to partner up with this product with you guys, see if it's profitable. And all these banks came back and said, no, like we won't make money on that. We don't want to do that kind of loan.
It's not in their best interest.
Not in their best interest,
okay.
Profitability-wise, because a 30-year fixed mortgage and amortization schedule, they make on a $400,000 loan double their money, $800,000, and I think this example
it's like $950,000.
$950,000 in interest. So they double their money in interest on a 30-year amortization schedule, which is it's rough, but it's the way that it's been for years and it's worked. So this loan, it's connected to your checking account, right? So if you have a $400,000 loan and you make $20,000 in a commission check, a paycheck, whatever, that money gets deposited into your checking account and it deducts from the principal balance on the loan. So your loan balance then is really $380,000, and you only pay interest on $380,000. The cool part is that rather than, when you have a mortgage payment, you can do a principal advance. You can call your mortgage company and say, hey, I want to send $2,000 just towards a principal on my loan, which is a really smart thing to do on a 30-year amortization schedule because your first payment on a $3,000 mortgage payment a month is probably $250 of it is going towards principal. And that doesn't switch for the first 21 years, I think it is.
Which means how much is going towards interest?
Almost double amount. Yeah.
It's a huge amount.
A massive amount. Yep. And so it takes years and years to get there. So the difference is that it's a checking account and your money's liquid rather than sending that $2,000 to the bank account and you can't pull it out unless you do a HELOC or sell your house. The money's in there for you to use. If you have a kid that goes to college, if you have to pay gas, groceries, stuff like that, the money's liquid. It's basically like this big bucket of water, right? You empty it out, you pay it off, and then if you need more, you fill the bucket back up. And it's just a really cool, unique way to pay off debt fast.
So I guess the main principle we got to understand is like you're only paying interest on the money that is actually borrowed, right? Minus what's in your checking account. So like that goes against what is borrowed and makes it so you're only paying interest on the net of what is borrowed on your mortgage minus what's in your checking account. And this is tied to your checking account.
Yep.
And is that checking account through
North Point Bank?
North Point Bank.
North Point Bank. They're the only ones
partnered with them.
Yeah, they're the only ones who do it right now and who it works with so far, and they're the only ones who would do it because banks and mortgage companies basically said, we
got it.
We wouldn't they don't make as much money on it, obviously. You can see from the comparison if we do the graphic, how much less in interest you actually pay over the life of the loan. So
yeah, that's interesting.
Yeah.
So revolving interest, right? Like, so that on a standard 30-year fixed mortgage, you're paying like an amortization schedule on the full amount that you start with, right? That is being paid the entire time, unless you advance principal and put more towards the principal. And so interest, like I guess if there is a downside rate, like the total interest that you're paying is about what rates are plus 1%, roughly. It's like a little over 8% right now because rates are closer to 7%.
APR,
yeah. And so, so the total interest that you're paying is at a higher rate, but you're only paying it on your balance minus what's in your checking account. So
Exactly.
if you have a lot of money in savings or in other, checking areas, is it just tied to that one account? Like if you have savings, do you need to transfer it into that checking account for it to actually
The account can be a checking or a savings account,
Okay.
either way, and then that deducts from your principal balance.
Gotcha.
The rate is based on, it's called the 30-day SOFR, the Secured Overnight Funds Rate, and it's an adjustable rate. And that rate's determined monthly.
Okay.
Right now, I think it's at like 8.111, which is a higher rate, but it's based on simple interest. And
Yeah.
based on the numbers, if you save money and you have positive cash flow, you save hundreds of thousands of dollars over a 30-year period.
Yeah. That's great.
Yeah. The other thing is that like if you pay your gas, your groceries and stuff, that rate is still the same for that entire month. And then it changes the next month. I think I already said that, but it's adjustable, which is why it's a riskier loan.
Yeah.
But I mean, if you look at the numbers and they say it's for the more sophisticated borrower, maybe not for someone going out and being a first time home buyer, but can be a good tool for someone who has investment properties or is a self-employed business owner who's paying taxes quarterly or at the end of the year, because you just dump all this money into this account,
Right.
take down the principal balance, and the amount you save is pretty phenomenal. So
Yeah. No, that's great.
yeah.
And that's where I see the use of it is like someone whose income fluctuates quite a bit, right? Where someone may make, $50,000 in a month, and then the next month they make 10, right? Someone like that can dump a lot more towards that checking account that's reducing the amount of interest that they're paying for that period of time, and it can just flex like that. You can also, they'll go up to 90% loan to value on your primary residence.
Yep.
So in that case, you get the opportunity to, create more borrowing power too. Like say, I want to, have my mortgage, but I also, say you already owned a home for 10 years and you've got a bunch of equity that you're going to dump into your place, right? You're only borrowing like maybe 40, 60%, something like that in some people's cases. And so you've got 30% extra that you could use to go out and buy an investment, maybe flip a home, do something, and then pay it back and reduce that amount of interest that you're paying.
Yeah. Well, the cool part with that is that if you buy an investment property and you have positive cash flow on that investment property going into this account every month, I mean, it's kind of just like this trickle effect of, you have more and more cash flow going in and out of here. I mean, you're going to pay it off extremely fast.
Yeah.
Yeah. So
that's awesome. So you look at like this graphic that we've got up here, and it shows, the difference between, on the left side, we've got the results of the all-in-one home loan, right, from CMG. You start with $400,000 as your principal balance on both sides, right, comparing it to a 30-year fixed conventional loan. And the total interest that someone would pay, right, if they were to basically just make their payments through this, because every time you make a payment, keep in mind that's reducing the amount that you're borrowing, right, and the interest that you're paying. So that's the power in this, where on a normal amortization schedule, you're reducing very little because the principal balance reduction is set up so small at the beginning, and then it gets bigger and bigger as the loan goes. So you can really win if you hold a fixed 30-year mortgage for a very long time, but most people don't. Most people refi every couple years or 5 years, and some even treat their homes like ATM machines, right? Like Dave Ramsey likes to say. But it's all about like that principal reduction happening faster. And so the results of this, and this is the same payments that are happening on both of these.
Yeah. Right? So this is it's really just I just did let's say a married couple. Each person makes $80,000 in a year. And that money going into your bank account obviously is taxed when it's deposited into your bank account. So it's after taxes. That's something to keep in mind. This is why it's good for people who are self-employed, because they don't pay taxes at the end of the year. But this is for someone, they make $80,000 a year. So money going in every month for each person is around $46, $67.
Yeah.
And then I also added just a $25,000 one-time deposit that just sits in that account. I don't know what average is for the nation, but if someone has $25,000 saved up and it's a rainy day fund, you might as well just put it into this account and have it deduct from the principal balance on that loan.
Yeah.
Obviously the results, if you're a saver, and I also there's another, compared to a 30-year fixed 7% interest rate. And that's what's on the right there. And that's how much interest you pay over the life of that loan.
So, all right. So let's recap this. You see it on the screen here if you're watching this on YouTube or Instagram. But if you're listening on our podcast, we'll just spell this out for you. So making the similar payments, only 80,000 years, dollars a year income, right? 400,000 borrowed on each side. One has paid over the life of their loan. Once they pay it off, one has paid it in 10.3 years on the all-in-one loan. The comparison loan is 30 years fixed. The interest paid total expense on the loan is $582,000 on the all-in-one loan, $958,000 on the 30-year fixed. 360 payments compared to 124 payments on the all-in-one loan. And then the savings ends up being $375,000 over the course of 30 years just by having a different loan product, which is crazy. And that's why there's a lot of buzz about these loans right now. And so nice for you that CMG is the only one that can do this, right?
Yeah, it's pretty.
Your market.
Super, yeah, it's so they also have it, like you said at the beginning, they have it in other countries, so that people can retire and own their homes. And here, it's just not as it's just not as widespread. We're the only one who does it. So yeah, it is pretty unique and can be a good resource. So
yeah, man, that's pretty awesome.
Yeah.
Well, very cool. I think this is a product that like people should pay more attention to. Like. And maybe even like looking at these numbers, like this might not just be for people that have like variable income and that are self-employed. Like I look at this and I go, okay, if you're going to make the same payment, like everybody gets stuck on the interest rate, right? It's like, oh, I can't pay 8%. Like 8% is terrible. I'd rather pay 6 3/4, right? Which is where it's like kind of at right now, like 6 3/4 to 7. It just keeps hovering around that. But you're on an amortization schedule that's going to start you in the favor of the bank, right? The bank has all the advantage. All the advantage. You're front loading all of your interest at the beginning of that 30 years, right? So the first like 5 years suck, honestly. It's painful on an amortization schedule. I don't even like getting paper statements on a 30-year loan, right? I'd just rather have it just come out, and I don't want to see what's going on because it really sucks in the background. On a 15-year loan, I actually like seeing what's happening, right? Because I'm like, okay, I'm paying more principal every month. It's kind of exciting. This is great. But on a 30-year, it's kind of a drag, honestly.
Well, the breakdown is, so $400,000 loan at 6.5%, you've got about $5,000 in principal and almost $26,000 in interest. So percentage-wise, you're paying, almost 5 times more in interest than you are in principal on a 30-year fix. That's why this product's
with where rates are at today.
Yeah. That's at 6.5.
Yep. So. Even better than where rates are at today. So, 5 times the interest at the beginning of that than what you're paying in principal.
Yeah. For every $20 you put in, you're getting, like $15 of that is going right into just principal or interest payments. You're not getting any return on that. That's just making the bank some money.
Yeah. So here's the most shocking thing about everything. Is James, you did a little research and found out the interest rate that this is equivalent to, kind of like it was in the high 2s, right?
Yeah. There's actually a simulator online. I don't know if there's a link we could put for that or something, but there's a simulator you can go through and put your income in, how much you have saved up in the bank, and then it'll spit out this whole simulation. This took me 10 minutes to do. It was really simple. Maybe even less than that, but there's an effective APR rate that it gives you you would have to beat the all-in-one loan. With this example, I think that rate was like 2.686 on a 30-year fixed mortgage.
Wow.
Which is impossible to get nowadays. So
if you can't see me right now, I'm scratching my head. I'm like, okay, so everybody's saying like, I wish I could go back to the pandemic. I wish I could get rates back in the 2s. Turns out you kind of can, right? It's just you have to trust like a new loan product that's out there. So that's mind blowing, man. That's pretty cool.
So you said you need $25K for a deposit initially to start up with that example.
You don't need that. That's just what for this example, that's what I used. I figured that's a reasonable thing for someone who's going to go buy. If you already are a homeowner or something, you have 25,000 saved up. Okay. Obviously depends on the person, but for this example, yes. Yeah.
Okay. So yeah, just to kind of play all the numbers together. So
yeah.
This gets even better if you have more influx of larger payments or whatever else too.
Yep. And your money's liquid, right? If you have, some people have, hundreds of $1,000s saved up in the bank. They're like, just in case.
Yep.
And it's like, well, you might as well make your money work for you. You don't have to put it in any investments. It just sits in this account and helps you pay down your mortgage, and you pay a lot less in interest. So
interesting. It's pretty cool. And 10% down, is that there, since they'll only do up to 90% LTV?
Yeah.
Is that the requirement?
Primary residence, 10% down.
Okay.
Second homes, 85. And then investment properties, if you want to do cash out on an investment property, it's 70% loan to value.
Okay.
But if you just want to do the loan, if you have a $400,000 mortgage, you want to do the loan on an investment property, 75% loan to value.
Okay.
So, yeah.
Got it.
And that can be like I said before. I mean, if your mortgage is $2,600 a month and you make $3,000, I mean, that's $400 extra that you're just
Yeah.
paying towards your mortgage by putting it into this account. So
Yeah. Because it's all about this program to me is all about principal reduction at a faster rate.
Yeah.
That's all it is.
principal, they call it a principal first mortgage.
Yeah. Even though you're paying more in interest, you are getting rid of the principal so much faster and reducing the overall interest that you're paying on the loan.
Yep.
And like we had a big change in our industry, right? When like TRID came out and the closing disclosure came out and all the docs are there right in front of you showing this number, right? Showing you that if you borrow $400,000, you're going to pay $958,000 over the life of the loan. And I thought like that was going to stop some people from moving forward on a 30-year amortization schedule type loan. And I think they look at it, they think about it a little bit, but it doesn't stop anybody. They keep moving forward on these amortization schedules. You know, and I think the truth of it is it's just not a great product, honestly. Like the 30-year loan, it's very traditional. We see it all the time, but if you can get something like this that can pay your mortgage off in a third of the time with the same amount of payment, like to me, it's just crazy.
Yeah.
It's a no-brainer.
The other thing too is that there's caps on the rate. So it can only go up a certain amount, 6% from where you buy it at, and it can only go down a certain amount.
Okay.
So there is obviously risk to it, but there are caps. It's not like you're going to be paying, $300,000 a month for a mortgage payment. And you can also buy the rate down. You can buy it down by a margin of 1.5%.
When you start?
When you
initiate?
start, yeah.
Okay.
It's like basically like doing a rate buy down on
Yeah.
a 30-year fixed loan. It's basically the same thing. You can buy that margin down and then it's adjustable, right? So it can go up and down, but I mean,
Yeah.
it's lower than what it is. So I think you can get like a 6.7% rate. It obviously costs you, depending on the loan amount,
Yeah.
a certain dollar amount, but it can be a good option too if someone's a little bit more worried about the risk of it since it is an adjustable rate.
Right.
So,
That's cool.
yeah.
Jackson, you're on the younger side of things in the business. What do you think? Like, do you think your friends might be interested in this sort of thing, or?
Yeah, I like it. I know a lot of like young tech professionals who have money in the bank that's like not invested. So I think there's definitely a subset of people it's good for.
I mean, and you've got some friends that have bought multiple properties already at like 25 years old, which is pretty remarkable, you know. So like someone like that, if they were to get a hold of this and like apply it to their investment properties or to their own home and get their home paid off by 35, I mean, that would be insane, right?
Potentially, yeah. I don't know
crazy.
what his cash or the person I'm thinking of. I don't know what their cash situation looks like, but
Yeah. That's cool. What if you did this multiple times? Would it just be like a separate checking account for like an investment? Like it would have to be, or is it all in one? You know what I mean? Like,
That's a good question. Yeah, if I had two properties, could I like refinance them into this and then use the same account?
Yeah,
against the principal.
What you would want to do is you would just refinance and you do it all in one. You would do, you could have two mortgages, but you draw, like, if you qualify, right? You qualify for, say your mortgage is $700,000, you qualify for $800, you put it all into one all-in-one loan, and then you put everything into that checking account for both. If you have two investment properties, your cash flow could go into that bank account for both investment properties. You pay it off at once.
so it could be one payment.
Yep.
For multiple
Yep.
properties.
So the balance.
It's a HELOC.
Which kind of helps you
Yeah.
stay organized too.
Exactly,
So
yeah.
you're not making all these different payments to everybody.
And it helps too because then you can lump sum everything and put it all into one.
Yeah, so
Yeah.
one balance in one account offsets both interest rates on both loans. So
Yeah, or it's really all one loan.
okay,
Right, because it's a HELOC and you draw against it. So if it's an $800,000 loan, I mean the loan is really just one loan.
yeah,
Yeah.
it would be two proproperties.
Two properties,
Yeah.
yes, but one
But,
exactly.
yeah, no, that works.
Well, I think a lot of people are like in that point where they're just like, I got 4 different credit cards. I got a couple debit cards. I got, maybe 2 or 3 different home loans if you have investment properties. And then I got investment accounts to worry about. And so you're like so spread out with all your like logins and everything. So that's kind of cool that you've got it all in one
Yeah,
place.
and I'm just working on a loan for a lady right now, and she's paying off her car loan. She's paying off all her credit card debt, and she's refinancing an investment property. So all of those will be all in one, and she'll deposit all her money into this account monthly and pay off her debt. I mean, even in the first year, I think she's paying off $15,000 more in principal than she would with her current interest-only payment that she's got going on. So
Interesting.
yeah.
And now with North Point Bank, how does that process work? Do people have to change banks, or could they just create like a direct deposit from their bank to North Point?
That's kind of the caveat is they do have to change banks to North Point Bank. You can't have a Wells Fargo and put all the money in there. But I mean, you see how much of a benefit it can be if you can save yourself $370,000.
Yeah.
It's worth switching over from Wells Fargo or U.S. Bank or in my opinion.
Rewards.
Yeah.
I don't think people have a ton of loyalty to like
Yeah.
banks that don't pay hardly any interest on their stuff, but
Not Wells Fargo.
yeah.
I hate Wells Fargo.
They ding you with fees every now and then. Yeah, like it's just a hassle, right? Like
Mm-hmm.
to switch everything over and make all your payments go somewhere else and stuff like that. But with North Point, do they incentivize anybody to switch over at all? Like outside of this, like I get postcards from Chase like every other day saying like, "I'll give you $900 if you switch to our bank," and stuff like that. But anything like that with North Point, or is it just pretty straightforward?
Not that I know of.
Okay.
Yeah. But
Cool.
I'm sure.
11-month CD.
Have you ever heard of North Point Bank before this, though?
A little.
Okay.
I think I've heard the name before, but
Okay.
I've never looked into it.
Yeah. I think this really the benefit is that they get more people, to bank with them. And
100%.
yeah.
I think it's a really smart move on their
Yeah,
part.
it is,
to
yeah.
Join up with a product like this. That's
Yeah.
pretty innovative.
Yeah, it's
So
awesome.
That's cool. And this has been in New Zealand for even longer, right? Like Australia, some of these places like down under,
Down under,
like
yeah.
that's where they've kind of figured this out, as far as how this works. But there's a lot of big banks and mortgage companies here in the U.S. that do not want this information to get out because they're making way more money on the other side. It's self-interested, for them to keep it with them.
Exactly. Yeah. I mean, yeah, it's been around for around 20 years, but it's really kind of a little bit under the rug, and
Yeah.
it's risk. I mean, it's riskier. It's not a fixed rate. People like a fixed rate because they want to make the same payment every month. But when you really look at what a fixed rate is and how much you're paying in interest, it's like, is that really worth the risk right now? It's
Yeah.
Pros and cons. So
Yep, totally. Well, everybody's looking to save right now. Like we're in an affordability crisis, and people are like, "How do I save a buck these days?" I don't know. There's not too many things I've looked at that are going to save you $375,000 in the next 10 years, but this one could.
Yeah.
That's a pretty good. I don't know, just stock on your future if you switch things up like this. So I think it's a really cool product. I think a lot of people could benefit from it, not just the niche type people. If they have 10% down to put down on a home, that might be the only limiting factor that I see is like you may have some people that just can't get there with the down payment. They need to go more the traditional route, build that equity up, and then maybe you can refi into this too, right?
Exactly. Yep.
Yeah.
Yep.
So they could do that later. And once they refi, you guys would pay off the pre-existing loan and any HELOCs that they had, basically. Like those
Yep.
would all have to go away because you guys are in first position.
Yeah, it all has. It's basically just like a regular refinance. Any other HELOC stuff like that, pay it off, and then you just switch over to this one. So
Could someone still later get a HELOC in second position on top of this?
I've never been. You don't really need it necessarily, right? Because you can always draw against something like this.
Okay.
I mean, I guess you could.
Yeah.
I've never been asked that before, but I mean,
I'm guessing just like a normal first loan, there could be someone in second position that comes in on top of that.
You could do a
But-
second. You could do. I mean, I don't see why not.
But with you guys being willing to draw up to 90% loan to value, you can still have a lot of flexibility there, which is nice.
Yeah.
So, and most secondary HELOCs will only go up to 90 anyways on a principal. Some even less,
Yeah.
some 80.
Yep.
And investments,
90's
it's like-
even sometimes rare.
yeah.
Yeah.
Usually on investments it's 70. So I don't know why you would. That's a good point.
No, but it's a good question.
Cool. All right. Any other questions or anything you want to go over, guys, as far as this goes?
No, I'm just playing with the simulator, so.
Oh, nice. Surprise, surprise.
Yeah.
A new Brock would go to town on that thing. So, anything else? Any closing thoughts on what benefit this has to people?
I think we covered most of it. I mean, yeah. Any questions? Let me know.
Okay.
Happy to help answer questions at any time. And yeah, the simulator is great. I mean, there's all sorts of stuff in there that I haven't even gone over really, but you can look at the chart of what the 30-day average SOFR is, the secured overnight funds rate, and then it can show you year by year of kind of where that's been. And right now, it's probably the highest it's ever been.
Yeah.
Historically, which is good news because
Yeah.
it would really go up historically.
For sure.
Numbers, statistics, whatever.
And what's the website that they can go to check that out?
Just all CMG all-in-one loan. Yeah, and I have a specific link, but that doesn't matter.
But that,
obviously,
just
but-
Google that.
Yeah, just Google CMG
loan.
all-in-one
Yeah.
loan simulator.
Okay.
Yep.
Sweet. And then what's your best number to reach you at if they?
Yeah, 720-202-2703 is my cell.
Cool.
Yeah.
All right. So yeah, we encourage you to call James if you would like to look into this product. If you're listening, going, this sounds way better than what I'm looking at on my mortgage statement every month. So this has been great. So thanks for joining us, James.
Yeah.
Really appreciate you being here, and hopefully this has been useful information for you. And make sure to stay tuned for our next podcast when we go over what a buyer's market actually looks like now that we're in one for the first time since 2011.